In this lesson, we're going to talk about, introduce, in fact, the process of adjustments. And this is a heavy topic. So if you were lost on sales taxes and discounts, this is really going to throw you for a loop. So if you might need to reallocate some of your studying time and shift a little bit of it to accounting. And please ask for help if you're falling behind or not understanding, because remember, it's a cycle and we just keep adding more and more on top. And if there's one step you can't do, then the rest are all going to be wrong, or at least so confusing that you're going to feel like you're lost. So on that note, what are they? I'm going to make a couple things perfectly clear before we go on. There's going to be video lessons, and I'm going to highlight stuff, but you can't just watch them and be done. There's a web page version, a text-based version, and if you open this, it looks like this, and you need to read this. This is like your textbook for this topic. It gives you much more detail, and it's much more specific. It's got some illustrations. I mean, I'm going to show you stuff, but I'm not going to read everything, and I'm not necessarily going to show you everything. So you have to kind of use this together with the video lessons and the learning examples to really be able to start to absorb all of the adjustments that are possible. And there are some common steps and processes for all of them. So once you start to get a handle of those, they go a little bit better. But you do have to put some effort into this midpoint of the course, because there's quite a bit of content. So let's look at, and I'm gonna, late invoices is just an invoice that comes late, and you have to make sure you record it in the right accounting period. And that's enough said. We're going to spend most of our time talking about these two main types of adjustments. Accruals, which we're going to define as something that builds up or accumulates over time. All that's necessary for an accrual to be earned is for time to pass. And there's about four, and there's more than four, but I mean, we're going to illustrate four, and they have a very similar process for all of them. And we're going to break this into two lessons. Then we go on to allocations and amortization. And it's called allocation because, much like accruals, one of the reasons you have to do adjustments is because time has passed, or things are happening, and you have to show the right amount of expense or revenue in the period. And you're not going to get a bill or an invoice for any of these. And you'll understand why as we go through them. But that's the real reason you need to do that you need to do adjustments, as it explains up here. This is the step in the accounting cycle. So after you've posted, you've done a trial balance, and you're about ready to make your financial statements, you have to make sure everything's perfect by doing adjustments. And then, and normally nowadays, we skip this process because computers don't need to do this process. We go right from adjustments and we make our financial statements, the last step being closing entries. Essentially, there are things like assets that wear out. There are things like interest that the bank just takes out of our account, or that we owe but have not yet paid. Right? I borrow money in the middle of the month. At the end of the month, if I'm making my financial statements, I have to make sure the right amount of interest has been recorded, even though I'm not going to pay interest yet. Not till next month, a month, on the monthly anniversary of me borrowing the money. So there's a whole bunch of reasons you need to do this, but I want to point out sort of the theoretical reasons. And there's basically, because on a quiz or a test, a written one, which I almost always give on adjustments, the why is basically going to be because of the purpose of accounting. And you recall what that is? Because that's going a ways back, right? Right to the beginning of the course. The purpose of accounting is to produce useful information for decision making. And to be specific, the purpose of accounting is to produce useful info for decision making. But specifically, what does that look like? What are the instructions that guide producing useful information? Well, you got three gaps, or three accounting principles. The first one is revenue recognition, right? That's the one that says, and yes, you should know what all these are now. Revenue recognition is where you record revenue when it's earned, not necessarily when you get paid cash. And the sort of the expense side of that is the expense or the matching principle or concept, which says that you need to record your expenses and your bills in the accounting period when you earn them, and not necessarily when you pay them off. And then the third one being the principle of conservatism, which essentially says that you overestimate all the bad things and you underestimate all the good things. And that way, if you're surprised or your estimates are off, everyone's going to be happy, right? Usually. So you lowball good stuff and you overestimate sort of the bad stuff. These are essentially the gaps that play into why we need to do adjustments. They help explain the reason that you have to go through this process. Let's look at the first half of our first main sort of type of expense, which is accruals, right? And we're going to look at these two because they're sort of the opposite side of the transaction, each of these. It's sort of the same thing, but from the opposite perspective. And now before we do that, I want to say how this is going to work on all of the adjustment lessons. If you go back to the syllabus, you'll see here we're on our first lesson for adjustments, part 1. There's going to be 4 parts. And when I do them, these are different than the exercises you're used to doing that are self-marking and give you feedback, because I want you to do them while watching these lessons. So they don't tell you how you're doing as you're doing the activities, because I want you to actually pause the video when I say pause and try them as far as you can get, and then play the video again and see how you did and learn why they're done the way that they are done. Trust me, if you don't give yourself a chance to learn and think and problem solve and attempt these, where else are you going to get the practice? Or if you just watch these videos, you're not going to get as much out of them. So I'll probably say this 1,000 times during these 4 adjustment lessons. Watch the video, pause it when I tell you to, do the exercises, and read this comprehensive adjustment note, probably more than once. So on that note, I'll stop harping and I'll go on. So here's what we're going to do. Prepaid expenses are things you pay in advance. So instead of, say, for example, a common one is rent or insurance. So instead of trying to remember to pay those bills, or if you haven't got sort of automatic withdrawal set up with your landlord or landlady, whatever, right? Sometimes you might want to pay them all in advance. You might get a discount if you do that. There's various reasons why it's done. But when it's done, the money you spent for, say, a year's worth of rent is not all an expense at once. In fact, if you moved out that very day, you would get your rent back. So it's actually a short-term asset. So as it says, I'm going to do separate examples, but you can use these for extra enriched learning. Right? So you can come back and read the note and look at these. I'm not going to go through these. I'm going to go through the activity that I have in the syllabus. So there are 2 accounts for every prepaid. You're going to have a prepaid expense account, which, don't be misled, that is actually a current asset. And for each prepaid, you're going to have the expense account as that asset wears out. And so in a typical sort of balance sheet, you'd see it after supplies or inventory towards the end of the current asset section, your prepaid asset accounts. And then on the income statement, they would just be insurance expense or rent expense, and they'd be in alphabetical order as usual. So let's try these couple. So exercise 23 is asking you to do, actually, before I do that, we're going to go on and we'll go right to unearned revenues. I said unearned revenues were the opposite side of prepaid. So imagine if you paid rent in advance for a year. The landlord, right, would have received all that money at once. Well, if you moved out the same day, their landlord owes you the money back. So guess what? That's like a liability. So the unearned revenue is a short-term current liability. And as time passes, because if you recall, that's all that's necessary, right? Accruals. All that's necessary is for the passage of time for an accrual to build up and have to be recognized. So unearned revenue is a current liability. And then as time passes, you remove the current liability and you turn it into revenue as time has passed. And the landlord, for example, has earned the revenue because they've provided their premises for a month, right? That's how it works. So again, you can go through some of these to see how they're done for extra understanding when you're studying. But I'm going to go through this one. So this exercise asks you to record so we have Ed's shop, we have Ed's landlord, and we have the insurance company. And Ed is going to pay $1,750 per month for rent and pays $950 per month for insurance. And he's going to pay both of these costs in advance for a year. And it's asking you to record the entry from both sides of those transactions. So for us, so Ed's shop, and then from the perspective of the landlord and the insurance company. And I'm also going to show you what the balance, sort of segments of the balance sheet would look like for all 3 of these individuals or groups. All right, so the first thing that we do is Ed Shop, January 1st, and this is where you pause the video and where I drop my pen. So try this as far as you can go. Use the adjustments note, the text-based one that I flip through all the time. This one. See how far you can get. Try it. And then play the video again. I'm going to do Ed Shop first. Here we go. So the first thing that we're going to do, and this would be two companies, so it would be two transactions. So on January 1st, Ed would pay prepaid rent. I'm just going to do that one first because I want to. And that's going to be 12 times this number of $1,750. That's a current asset. That's been paid in advance. And it's paid in advance, so that's cash, right? $21,000 is paid. Piece of cake. Second one, another check goes off to the insurance company. So it's going to be prepaid insurance. And these are assets, right? We debit assets to make them go up. This would be 12 months of $950 of insurance per month is $11,400. And we, again, will pay cash of $11,400 to the insurance company in advance. That's Ed done. That's what happens January 1st, paying them in advance. What does that look like? So what does Ed's balance sheet look like on January 1st? Well, he's got some level of cash. We don't know what. And that's normally followed by accounts receivable. We don't know what's in there. We don't know how much. And then there's probably going to be some supplies. So this is the order that's pretty traditional that we use. We don't know what these values are, but this is sort of the order. And then sort of after that, you would have any prepaid current assets, which are not especially liquid because your rent doesn't do anybody else any good, right? Or neither does your insurance. So next you would have prepaid. I'll just put them in alphabetical order. Prepaid insurance, like this. And then below it, you'd have prepaid rent. And it would be so this is on the first. So this would look like right away. You'd have these values. So prepaid rent would be $21,000 and prepaid insurance would be $11,400. And that's what sort of your short-term balance sheet segment would look like. So then what would it look like at the end of the month after you have to do the first month's adjustment? So what is an adjustment? Well, time has passed, which means Ed's shop has used up a month of rent. They've been there a month, they owe rent, except they've already paid it. So you have to recognize that they no longer have prepaid January. It's been used up. And used up is like a part of the definition of an expense, right? You use up wealth. It's consumed. And that there's no future benefit for it. So it has to be basically vaporized from your balance sheet via the income statement. So here's what you do. At January 1st, you would go rent expense. And it would be 1 month's worth, which is $1,750. And you're not paying cash, you've already paid. So you're not crediting cash, you are crediting prepaid rent to lower it by $1,750. Right? So down here, current assets again, you'd have sort of the same thing, except under prepaid rent, instead of $21,000, you would have $21,000 minus the adjustment, which is $19,250. That's the value left in the prepaid portion of the rent. Likewise, prepaid insurance would have to be adjusted as well. So you would go insurance expense, and that's $950 a month. So that expense is for the wearing out or the evaporation of the prepaid insurance. Because now you used up a month of protection, so that value is gone. So we credit this current asset, and the value goes to expense to show that wealth vaporizing as we used up a month of coverage. So our prepaid insurance now was $11,400. We've now taken off $950, 1 month's worth. And this is what, again, we don't know what these are, but they would come first, and then afterwards you would show these values for the prepaids. Try the other companies. Again, pause the video, try what would it be for the landlord, what would the perspective be, and this is now the unearned revenue side, right? So whatever happened for the prepaids, for the landlord or the insurance company, those prepaid expenses for Ed's shop would be unearned revenue at the time for those companies. And then play the video, see how you do. Landlord. So that's just the rent one, right? So on January 1st, the landlord is getting cash, right? Ed's shop is giving the landlord cash, $21,000 worth, right? It's just the reverse. So we're receiving the cash as the landlord, so we debit cash $21,000. This is not revenue yet. We've done nothing to earn it. That's the revenue recognition gap, right? So what we've got is money that we would have to pay back if our tenant left. So it's a liability, and it's called unearned rent or unearned rental revenue, something like that, right? And we would credit that $21,000, and that is a short-term liability. So under liabilities, we would probably have something like accounts payable, and we don't know what that is. But then somewhere in there, we would have and before the long term, we would have our unearned revenue or unearned rent as a short-term liability, and that's $21,000 right now. So you can imagine where this is going. On January 31st, at the end of the month, if all of these companies adjust every month and put the right amount of expense and revenue in the accounting period for the month, then you've got to add the revenue you've earned by providing your premises for the month. So at the end of January, you've got to go unearned rent. So this is liability. So we're debiting it now to remove or reduce the liability by $1,750, and that's now earned. So an account name might be rental revenue, and we credit an actual revenue account because we have now earned the money we've been paid by providing our premises for a month. So on January 31st, our accounts payable is whatever it is. We don't know. Whatever. It doesn't matter. And then somewhere in there, we have our current asset of unearned rental revenue or unearned rent, and it has gone down by $1,750. So it's going to be $19,250 of liabilities. Notice how they match up, right? Ed's shop has prepaid rent not yet used up of $19,250. And the landlord has a liability of the same amount owing back to Ed's shop if Ed should leave. So our unearned rent for the landlord's $19,250 as well. Well, guess what? This is going to go pretty similar. So over down here, we'll put on the same line just for our eyeballs. Prepaid insurance, we're going to use up a month at $950 a month. So the insurance company... we're receiving it first. So the insurance company as well is going to get cash of $11,400, and also will have unearned premiums, are what insurance payments are called, unearned premiums, which is the liability of $11,400. They haven't provided the insurance yet, so it's an unearned type of revenue, a liability. So on January 1st, they would have probably some kind of accounts payable as well. Who knows what they'd be? And then they'd have their unearned premiums, their liability account for the full amount that they received, $11,400. But then on the end of the month, they would recognize having earned a month of premium revenue because they would have provided insurance coverage. Even if there were no claims, they still would have provided the coverage. So they'll lower their unearned premiums short-term current liability account, and they will credit some kind of revenue. So it's probably premium revenue, like that. And it'd be 1 month's worth, which is $950. Right? Whoops. So it's clearly each of these this is the opposite or the other side of the transaction, the other perspective of the same of this one, right? Which is why the numbers are always the same. This is what it looks like when it's an expense being used up. This is what it looks like for the company that's earning the $950 as it's used up. And then likewise, or very similar, you'd have, again, some kind of, probably the first thing would be an accounts payable, and then you'd have your unearned premiums, which is now $950 less, right? Which is $10,450. Because remember, Ed's shop has $10,450 of insurance left, which means the insurance company has $10,450 of a current liability, the unearned revenue left. And that's how you do that. That's how that's done from different perspectives, which essentially teaches you how to deal with prepaids as a business and how to deal with unearned revenue as a business, because you can have either.